This is a requested topic, the 2008 recession, also known as the Great Recession. What caused it? What is the real reason it happened? We are going to do an in-depth study about it, and I'll tell you how it happened, what was the result of it, and right now, are we going to a new recession? We'll touch on that also. Maybe I'll create another video about that. So this is a requested video. How did the Great Recession, the 2008 recession, the Great Recession that swept all over the world and caused nearly $5 trillion of loss in the first year itself, and the effects are said to be more than $20 trillion across the globe. That's how big the recession was. So what started it and what is the reason it happened? If you want the one word answer, it is greed. Greed caused the recession, and you might say, oh, that is true for any recession that happens, but this is different. This is greed from one particular branch of work, that is bankers. Greed from bankers caused the recession. How? Let's get into it. Now, to understand the recession, how a banking sector recession turned into a global recession affecting real estate and every other sector, including the markets, everything. How that happened, you have to understand one fundamental term and where the seed for this recession was set, or what is the main thing that was used, the tool that was used wrong that caused the recession. So what I'm talking to you about is MBS, or mortgage backed securities. This is one term which you have to understand. Without understanding this, you won't understand the video further, or you won't understand where the seed is. So mortgage backed security is also known as private labeled MBS. This was created by Louis Ranieri in the 1970s when he was a bond trader at the Solomon Brothers. At that time there was no other instrument like this. This is a unique instrument which he created. The idea behind it is very simple. What Louis Ranieri did is he actually pooled a lot of more mortgages together and created a bond out of it. So pooling a lot of high quality mortgages together, the risk doesn't go that high, but the reward goes high. The reward increases, but the risk doesn't go high accordingly. So if the risk is this much, the reward increases this much. That's how the idea is. So AAA rated, which is the highest rating you can get for a bond, that's the rating of the mortgage security, the MBS. That is what it gets, because you are pulling really high quality bonds together, and that is creating a really high quality bond as a result. This is how Louis Ranieri created the MBS. This is the original formula for the MBS. You have to understand this. The initial ones that Louis Ranieri created, they were cherry-picked mortgages, and so they never failed. That is the gist of it. That is what you have to understand. The mortgage bond has never failed before this because they were cherry-picked. It was high quality mortgages that was put into the bond. The modern MBS that failed, that is a mutated form of the original MBS. It is not even close to what Louis Ranieri created. They created a tool that is so weird and so absurd that it just blows my mind. So why did they create it? That's the main question. See, bankers, they get a 2% commission on every MBS that they sell, right? So $10 million is the average MBS size and 2% commission on that. So you can understand how much commission is there, how much the bank is making. So they are making 2% like clockwork. But finally, there are only so many good homes and people with good enough jobs to get the mortgage, right? So what do? They started mixing AAA rated mortgages with double Bs, that is, not that good. People who don't have that good of a credit rating, they will give them the loan and they will actually put it together, and the rating of this bond was taken at face value. it didn't change. Actually it should, but it didn't. They went, this is what was happening in the 90s, 2000, that era. After that they went further. They put something called subprime. This is the main reason, one of the main reasons why small bond failure actually resulted in the entire real estate and then the markets crashing. So because there were not enough mortgages going around, what they started doing, they started cutting the quality of the people who are getting the mortgage. So people with no income verification, people who couldn't afford the home, they were given homes. These were called subprimes, and that's rated C or below. And even then, the entire mortgage bond, the MBS, because it is diversified, they still rated it at 90 to 93% AAA rated. So the face value of the bond didn't change, even though the constituents of the bond changed. They even did things like, in the last stages, they gave people loans at teaser rates. So very low interest rates, artificial rates were given to the subprime lenders, and they are just desperate for a home, so they are just getting the home. But they don't know how bad the situation is going to get. When one default happens, it's okay, but if everyone starts defaulting on their mortgage, automatically this is going to be a big problem. Some people actually knew about this problem coming into play. Even before the situation actually came out, many people knew that. One of them is Michael J. Burry of Scion Capital. He is all over the news. When you search about the 2008 recession, automatically he comes up and everyone is, looking into it. He was the one who approached the banks to create an instrument to short the MBS, because he saw that the mortgage-backed security is not going to hold up and he wanted to make money on it. He's a smart guy. So he went to the banks and shorted nearly $1.3 billion of total MBS, and that actually yielded him a really big reward. Jamie Mai of Cornwell Capital also saw this opportunity and he invested in credit default swaps. The instrument that was created was called credit default swap by Michael J. Burry. Jamie Mai also invested into it, and he made about $120 million from the crash of 2008. So if you are betting against the MBS, you are going to call it a credit default swap. That is the instrument that was created. And later on, during the recession, this was the most coveted thing in finance out there, the best purchase of finance at that time. Now you might be thinking, how did just this one thing, MBS failing, create this big of a problem? Well, they created the bankers, the greedy bankers. This is where they went wrong. If it was just MBS failing, it might not have been that severe as it was. But the reason the situation got so severe is because they started betting a lot on the mortgage-backed security, and they actually started getting greedy, creating new things, new tools to bet on it. Basically gambling. So they created something called CDO, collateralized debt obligation. What is a CDO? CDO is very simple. When the market deems a bond too risky to be sold, when you have certain mortgages or certain subprime loans, all these kind of things that are not selling, they will take it together, put it into a pool again, and then the whole thing, because all these things are not selling, they are putting it together, the whole thing is considered diversified, rated AAA again, 92-93% AAA rated by the weirdos who didn't check what this thing was, and people were buying it again at face value. So a CDO is basically something that doesn't sell, diversified, called diversified, or just put a AAA rating, false AAA rating on something, and they're just selling it. And this was the problem. They also created something called CDO square, which is a CDO of a CDO. I'm not going to get into technical details of it because I don't want the video to get too long, but Understand this, they were trying to create as many tools to bet on MBS as possible. They also created the opposite side of it, which is called synthetic CDO. Synthetic CDO was through the credit default swaps. So betting against the market, again, the MBS, but in the opposite side. Basically what they did is they created a market that was 50 times bigger than the original. The insurance of the bond was 50 times bigger. The market for insuring bonds became 50 times larger than the bond value itself. So if this collapses, there's no way it's going to tally. That's the big problem that they created. For example, if there is $50 million of subprime loans out there, there would be $1 billion betting on it on the CDO, CDO square and CDO synthetic CDOs. So initial investment of just $50 million or the insurance of a $50 million bond is becoming $1 billion. That is a real big recipe for disaster and stupidity on astronomical levels. So obviously this is going to crash. If your insurance of a certain house, I'll give it to you in a simple form. If your house is worth 1 CR, suppose, if your house is worth $1 million, let's take dollars because we're talking about dollars again, $1 million, the insurance of that house, the amount of people who are betting on it will be 50 times higher. There's no way that all these people can get paid off if this house burns out, right? There's no way, because the market is 50 times larger than the original value of the commodity it is insuring. That's where the problem came. This created an inflated market. Automatically the real estate, all these markets were inflated, and ultimately the bubble burst. What else can it do? Because you're creating such a stupidity happening here, it's going to burst. So what was the outcome? $5 trillion of pension funds, real estate, 401ks, all these things disappeared in the first year itself. This is just in the US. The overall global effect of this, because this is a very large economy that was affected, automatically the ripples cascaded all over the globe, and the effect was so large that it actually cascaded into the entire globe. The effects were $20 trillion. Some experts are even saying $30 trillion. No one knows where the end is. 3 million households lost their houses basically. That is just in the US. 400,000 people were employed, and this is just in the first year. So 400,000 people were unemployed like this in the first year. 50% of the Dow Jones average was wiped out. $439.6 billion was spent by the US Treasury to recover from this. 182 billion was the federal bailout to AIG. So you can understand how deep this problem was. This is one of the biggest recessions after the 1929 Great Depression, but the Great Depression was a totally different thing. The effect of this was so large, the 2008 recession, some say that we are still suffering from it, and when we are suffering from it right now, we are going into another thing called financial stagnation, which is going on right now. This is not a recession, it is something very different. And it is cyclic. Many people think that it is the end. I don't know if it is the end, but I'll tell you about it in the next video, because this video has already gone too long, and probably you might not hold your attention that long. So in the next video, I'll tell you what's happening right now, what's my analysis on it, and what are the best ways to invest in this thing that is going on. It is a very weird phenomenon. If you are interested in economics or in the markets, you will be enjoying the next video also. So if you have any comments, suggestions, questions about this video, if I got anything wrong, whatever, put them in the comments below. If you have any topic requests, you can put them also in the comments below, like this topic request. Like, share, subscribe. This has been Jace for TopEvt. I'll see you in the next video.